Hi, everybody. This is David Gully, and this is the January 2022 Monetary Policy Update. Please, if you have a chance, visit us at Bentley EC 391. So our agenda today, we're going to review some important policy changes that have happened since our last update in August of 2021. We'll do a quick review of the current economic situation using the agri-demand, agri-supply model. And then we'll talk about some really interesting inflation dynamics in terms of whether the current elevated inflation rate is temporary or is it relatively longer lasting. And this is going to have important policy implications for the Federal Reserve. So let's look first at the November 2021 FOMC meeting. So they announced that in the months of November and December that they will begin to reduce the pace at which they're buying Treasury and mortgage-backed securities. And so, for example, they are going to be reducing Treasury security purchases by $10 billion per month in November and December, and then $5 billion a month in mortgage-backed securities. And this announcement was very, very well anticipated, and so didn't cause really any market disruptions. But what wasn't really anticipated was the fact that the Fed didn't put a figure on subsequent months in terms of the volume of the taper. In other words, what they didn't do is put it on autopilot as they did with QE3. There, what they did is they had a constant pace month after month after month, and they specified this in advance. And so what they did, in effect, is they left themselves some maneuvering room to either speed the taper up or slow it down, depending on economic conditions. But what's interesting is when you read the minutes of the November meeting, is that none of the participants, none of the decision makers had any interest at all in slowing it down. Indeed, the genuine or the preponderance of the evidence suggests that they were concerned about potentially speeding it up. At the December meeting, that's exactly what they did. They doubled the pace of the taper. And so instead of reducing purchases by $15 billion per month from the beginning $120 billion per month, now they're reducing purchases by $30 billion a month. That's $20 billion in treasuries and $10 billion in mortgage-backed securities. And at this pace, if it maintains, quantitative easing will end, the taper will end in March of this year. And this is kind of referred to as the Powell pivot in terms of the idea that the Fed is now pursuing a relatively less accommodative policy more quickly than was anticipated even as late as August of 2021. Another thing they did is they retired the word transitory in describing elevated inflation, because for a number of meetings and a number of policy statements, the Fed emphasized that the current or the then current elevated inflation rate was viewed to be transitory, in other words, temporary, the idea being that various factors that were putting upward pressure on inflation would tend to abate. And they also expect that the Fed's three-part test for raising the federal funds rate will be met perhaps earlier than they had anticipated. And so their three-part test, and we've covered this in an earlier video, is that inflation has to reach 2%. It has to be moderately above 2% for some time, because recall that in August 2020, they announced a new policy regime where they're trying to target average inflation at 2% over a period of time, not treating the 2% as a ceiling or even symmetric in terms of using their previous verbiage here. And then finally, the third part is they want to be at the long run supply curve. So using the agri-demand agri-supply model, the Fed, in other words, wants to make sure that the economy is at long run supply. In other words, they've achieved their maximum sustainable employment as part of their dual mandate. They're also, in their forecast for 2022, they're expecting relatively higher inflation, actually substantially higher inflation, and more federal funds rate increases in 2022 relative to only 3 months prior from their September 2021 forecast. And so what we can do is use the agri-demand agri-supply model to visualize a lot of what's going on. And so on the vertical axis, we can put the rate of inflation. On the horizontal axis, we can put the level of real GDP, usually abbreviated with a big Y. And so here we have the long run agri-supply curve. And this represents the economy's maximum sustainable level of GDP, given labor resources, technology, capital, and other factors. We have aggregate demand, which can be thought of, remember, as consumption, investment, government spending, and net exports. And then finally, we have the short-run ag supply curve, which remember describes firms' short-run production decisions, not including longer-run factors that drive long-run economic growth. And so roughly speaking, in February 2020, we were probably around the ballpark in terms of being on the long-run ag supply curve. And the inflation rate at the time was a little bit, I'm rounding a little bit here, was something around 1.6% by the Fed's preferred measure. So they weren't exactly hitting their inflation target, but we were certainly at least in the ballpark of the long-run ag supply curve. And then what we observed is, thanks to COVID, is we saw a very, very steep decline in ag demand. And we also had a relatively large decline in short-run ag supply. And so as a consequence of these two shifts, we saw a little bit of a decline in the inflation rate, not very much, but a large decline in GDP and employment. So this might be right here. This might have been, say, in my bad handwriting, might have been, say, April 2020. Subsequent to that time, thanks to expansionary monetary policy, expansionary fiscal policy, and a general improvement in the COVID situation, we've got a slide in this in a minute, ag demand has shifted dramatically to the right. And so as a result, that's putting upward pressure on inflation and also upward pressure on GDP. And so perhaps, here we might be something like January 2022. So we've got, notice, an elevated inflation rate. And we are in the ballpark again of the long-run ag supply curve. Now, I've drawn it to the left of long-run supply because we probably still do have some excess capacity, but not nearly as much as we did as late as even August of last year, when Chair Powell laid out his argument, and we'll talk about this in a minute, his argument for the fact that inflation was relatively temporary. And so to summarize here, the idea is that thanks to COVID, is that ag demand fell dramatically as its short-run supply, but the decline in ag demand was larger, so that on net, inflation declined. But what's happened since then is there's been a gigantic rebound in ag demand, but short-run supply hasn't kept up. So in other words, we have very high demand, relatively constrained supply, and that pushes up inflation. So in terms of the rebound of ag demand, we've got a number of factors going on. We had exceptionally, and still have exceptionally, expansionary monetary policy. We have very expansionary fiscal policy. For example, the various stimulus checks and other programs the government implemented beginning in 2020. And then for the most part, a dramatically improved COVID situation. So all three of those things are working to shift ag demand to the right. So as a visual example, here's retail sales. And so you can see initially, during the beginning part of COVID, there was a giant decrease in retail sales. But you can see also that there was a dramatic rebound in retail sales. But notice that retail sales did not simply more or less return to trend. And it's this gigantic increase in demand that's helping to put upward pressure on overall inflation. To give you a specific visual here, look at the difference between inflation in the goods sector of the economy and inflation in the services sector of the economy. That's extremely dramatic. And so what that suggests is a lot of the increase in demand is going for goods, stuff, in other words, in particular, for example, durable goods. Demand for washing machines and televisions and cars and so forth has skyrocketed, and it's been difficult for supply to keep pace. Speaking of supply, what's happened is that we haven't had a corresponding rebound in short-run ag supply. And the general idea is ag demand can rise really very rapidly, but it takes a while for short-run supply to bounce back along with it. So it's harder for supply to keep up in demand, especially when demand ramps up pretty quickly. So to give some specific examples, One of the most famous ones recently has been the shortage of various computer chips, all the way from various, very simple processors to, very complicated CPUs. Over time, that's likely to diminish. Scarcity of workers, in other words, a constrained labor supply. A number of workers have left the labor force, and it's an open question of whether or not they will return. And then finally, the global supply chain. So for goods, very few goods, relatively few goods, especially in advanced economies, are produced all within a country. The supply chain is literally worldwide. And so this supply chain is very subject to shocks and is a little bit on the delicate side. So for example, here, right now, there's a scarcity of truckers to get cargo containers inland. And everybody has seen the pictures of the cargo ships sitting off the ports of Long Beach and Los Angeles, for example. But even once the containers get unloaded, there's not sufficient enough truck drivers to get those containers to where they need to go. So let's now talk about inflation dynamics. And so the big issue right now is the current elevated inflation. That's the Fed's verbiage here. Is it relatively temporary, or in other words, maybe self-limiting, or perhaps is it longer lasting? And unsurprisingly, this is a really major input in terms of what the Fed should do or will be doing with its monetary policy decisions. So if team temporary is right, in other words, all these factors are going to work to, over time, reduce inflation, then the Fed has a chance to leave policy relatively accommodative so that it has more of an opportunity to achieve its second part of its mandate, maximum employment. But if team longer lasting is correct, then maybe they don't have so much policy room to maneuver, because a relatively high inflation rate, as we'll talk about in a few minutes here, can do some substantial damage to an economy. So what the Fed did in December officially is they retired transitory. So they did that in their statement, and this was sort of foreshadowed by Chair Powell in some congressional testimony, saying that they were really considering doing that. That's of course what they did. And so he pointed out that inflation has been substantially, and these are pretty close to his exact words, more persistent and higher than anticipated as recently as August of last year. And so what they did in November is they tried to clarify what they meant by the word transitory. Transitory is generally thought of as temporary. In other words, self-limiting and not lasting for very long. So what he did instead is he defined it, or tried to redefine it anyways, in terms of, will the current elevated inflation rate leave a permanent mark in terms of higher future inflation? And so if it's transitory, that won't be true. Well, it turned out that this really wasn't very helpful in terms of a clarification. So let's have some visuals here. So the Consumer Price Index, a very popular and well-known measure of inflation, has been exceptionally elevated. So for example, recently, the inflation rate reached a value of 6.8%. And as a consequence, that's substantially more than triple the Fed's current value of inflation, or current target of inflation. Even the core CPI, which excludes food and energy, is still elevated at very nearly 5%. The Fed's preferred inflation target, the PCE inflation measure, this is a broader aggregate inflation index, and it tends to run usually lower than CPI. It still is also substantially elevated. So for example, the overall PCE inflation is running very nearly at 5%. The core PCE, given by the red line here, is running at around 4%. So double and more of the Fed's going target. So we need to think about, well, when does temporary inflation become more permanent? So one thing that might happen is that continued expansionary monetary policy pushes on a constrained supply. In other words, expansionary monetary policy keeps pushing up aggregate demand, and higher aggregate demand, pretty intuitively, can work to increase inflation and this is the critical part, make it more long-lasting. Likewise, it's also possible that inflation expectations might become unanchored. One sort of side effect or symptom of this is that velocity, in other words, the rate at which money changes hands, increases. So as people expect higher inflation, they tend to get rid of their currency, their money in general, not just the physical currency, but the electronic version as well, more quickly because they expect it to lose value. And when that happens, that works to push up prices even more. And so, for example, going back to the very famous equation of exchange, MV equal PY, so M is the money supply and V is velocity. So if the money supply is rising, which of course it has pretty dramatically, and people expect inflation to increase, so they start spending their money more quickly, that increases velocity. And so with velocity and the money supply rising, that puts upward pressure on the left side, of course. What does that translate to? That's going to mostly translate into higher prices because the growth rate of real GDP is relatively limited. It's constrained by physical factors. The growth rate of prices, inflation, is much less constrained. And then finally, what can happen if nominal wages rise relative to productivity? In other words, costs tend to rise. That would tend to shift the short-run supply curve to the left. That will further elevate and make inflation longer lasting. And if something like this happens, this might start generating what's known as a wage price spiral. So will these supply factors that we talked about improve? The general answer is yes, they're going to, but how much they're going to improve and how quickly they're going to improve are unknown. So for example, right now, as we mentioned, we're relatively scarce on various types of computer chips. Already, companies are ramping up production and expanding their production capabilities in terms of building new plants. And as a consequence, in a few years, we're going to have more chips than we know what to do with. So that will reduce in terms of the supply constraints. Other things will get better. For example, ports will eventually clear. This might take a while, but it will probably happen. And then finally, over time, as workers come off, say, for example, unemployment benefits, their savings start to dip a little bit and so forth, they might move back into the labor force. Now, when this will happen and by how much it will happen, these are very uncertain. In fact, this aspect, the supply of labor, in other words, this is probably the most uncertain in terms of by how much and when it will occur. So in the longer run is, one of the questions that firms are dealing with right now is, well, to what extent will they continue to have a global supply chain? Global supply chains are very effective in terms of keeping costs down, but they can be relatively inefficient if there's any sort of disruption. And so what firms might be considering is, well, are they going to pull in or make their supply chains more narrow in terms of their geographic reach? So these just-in-time inventory, that's JIT, just-in-time, they're not very robust to disruptions. They're fragile, in other words. Well, that's an uncertainty here that firms are wrestling with as we speak. So how about demand? Well, will demand growth slow? Well, probably, but again, the timing and the extent are uncertain. Well, right now we've got, for example, a pent-up demand for goods, durable goods and things like this. Over time, that will fade out somewhat. We have the end of our fiscal expansion. Stimulus checks, things like this have already ramped down. And so that's going to work to put some downward pressure on demand. And then finally, what's already starting to happen is the Fed's been running an exceptionally expansive monetary policy. This is starting to pull back, as we mentioned. So they are already reducing the speed of their quantitative easing. So they're buying relatively fewer treasuries and mortgage-backed securities now. And at some point, probably in 2022, they'll be raising the federal funds rate. So now let's look at Jerome Powell's dashboard from his Jackson Hole 2021 speech. And so what he did is he made a case for inflation being relatively temporary. So he went through and he gave 5 points and 5 arguments, therefore, in terms of why inflation at that point, he and the rest of the Fed thought was relatively temporary, transitory in their words. And so at the time when he made this speech, the evidence seemed to be, or at least the preponderance of the evidence, seemed to suggest that, well, Team Transitory was on the right track. So what we want to do now is see, well, in the subsequent 4 months or so, how have those various dashboard items held up to scrutiny? So first, His first argument was broad-based inflation measures were relatively stable, meaning some inflation indicators were increasing simply because of relatively extreme increases of a few specialty goods. Whereas the middle of the pack in terms of goods and services, those prices weren't increasing by very much. One of the specific measures he talked about was the trimmed mean PCE. And so a trimmed mean is you take off the highest inflation goods and services that are increasing, you take off the lowest, and you calculate an average, but you get rid of the outliers on the high and the low side. And so for a long time, the trim mean PCE was hanging around in the general 2% vicinity. But in the last few months, trim mean PCE has started to increase. By no means is it out of control. So in other words, the middle of the pack price increases of goods and services is still only around, less than a 2.5% annual rate. But that's a notable increase from when Jerome Powell gave his speech. Another way we can see this is looking at what's called the median CPI. And so the green line and the purple line, these are the overall CPI, and the purple is the core CPI. So these measures we saw in an earlier graph. You also have what's referred to as the median CPI. So this is literally the good or service right in the dead center in terms of its price change. And so notice that that was, at the time of Powell's speech, not giving any signal that inflation was increasing, but now in the last few months, again, granted, still only around 3%, that has increased pretty dramatically. Likewise, the 16% trimmed mean CPI, that's increasing even more dramatically. That is along the lines of the trimmed mean PCE that we had in the previous graph. This is based on the consumer price index. So it's a narrower basket of goods and services, but even still, it has sort of broken out and is showing a dramatic upward trend. So on those two items, sort of the broad-based inflation pressures, Team Transitory is starting to run out of gas here. Another argument he made was that goods that had seen relatively high inflation rates were already starting to moderate. So for example, this is the measure of the inflation rate in durable goods, televisions, washing machines, things like this. And you can see that relative to the historic average, going all the way back to the 1990s here, that durable prices have increased very dramatically, far, far outside of their typical range in the last few decades. And this, of course, was driving up overall inflation. But Powell was saying, well, this is starting to moderate, and that's true. But they're still relatively high. So it's difficult to imagine that the inflation rates on durables will continue, especially once supply chains get caught up, and especially once pent-up demand starts to fade out just a bit. So here's another example. This is the inflation rate in cars and trucks. So car and truck prices have risen, as you can see here on the right, very dramatically, especially relative to their historic recent average over the last few decades. And here, Chair Powell, there's some evidence for this in that there's been a notable moderation in the growth rate of car and truck prices, used car and truck prices. And the idea here is that over time, as the chip shortage becomes less of a problem, the supply of new cars and trucks increases, the prices of used cars and trucks will tend to moderate. So it's very unlikely that this will continue. He also mentioned that at the time, wage increases were relatively moderate. And so here we have the Atlanta Fed's wage tracker. And so what this does is you can break out wages by many, many measures here. So the sort of dark blue line right here in the middle, it's a little bit hard to see, is still not increasing very dramatically. But if you look at the first quartile of wages, in other words, these are the folks who are earning the lowest wages, their wages have seen the most dramatic increase here recently. And you can see overall in the last 3 to 4 years, as the economy is relatively strong, low wage workers who are in relatively high demand And great for them, they were seeing relatively strong wage growth. So by this measure, wage growth overall is not really terribly out of line. We can also break it down by age. And you can see here that the overall, again, is in the blue right here. And the youngest workers, and young workers tend to have relatively low wages, and that's not a criticism of young workers. They, at the time, being young, they don't yet have a lot of education. They don't yet have a lot of on-the-job experience. That changes, of course, as they get older and achieve higher educational attainment. But notice here that wage growth for those workers, and this is very often in the leisure industry, hotels, restaurants, things like this, they're seeing very substantial wage growth, on the order of nearly 10% at an annual rate. But even still, broad-based overall aggregate wages haven't increased very dramatically. But if we look at a different measure of wage growth called the employment cost index, this is a broader measure. This includes not just wages and salaries, but also compensation in terms of benefits. Note here that since Chair Powell has given his speech, that's increased pretty dramatically. In fact, he mentioned the employment cost index specifically in his speech as being restrained. Well, it's become somewhat less restrained since his speech. And so this is some evidence that in the aggregate, production costs, employment costs are starting to rise pretty substantially. Chair Powell also suggested at the time that long-term inflation expectations remained in Fed verbiage well anchored. The idea is that if inflation expectations are anchored, people act like inflation isn't going to increase. And so as a result, they don't take actions that help inflation to increase. So they restrain their spending, for example. And as a result, that helps keep inflation moderate. But based on survey data, this is from the New York Fed and the Survey of Consumer Expectations, looking ahead 1 year and looking ahead 3 years, inflation expectations are starting to increase and increase pretty dramatically. And as we discussed before, if inflation expectations rise, those increasing inflation expectations can tend to drive actual inflation higher. And then finally, he made sort of a bigger picture argument. He argued that there's a whole bunch of forces, factors in the global economy that's working to keep inflation relatively low, not just in the US, but around the world. And so he cited 4 particular ones here: central bank credibility, in terms of the public at large believing central banks will do a good job at controlling inflation over time; relatively high worldwide saving rates, that help restrain, for example, consumption a little bit; globalization, meaning trade and global supply chains, which help keep production costs down; and the demographic factors. So, for example, aging populations. Many countries are dealing with this situation so that we're having a relatively slow population growth, or some countries are even seeing declining populations. These factors also work to keep aggregate inflation down. In terms of how these forces are working or not working to keep inflation down, this is a little bit harder to tell because the current COVID-based factors are tending to overwhelm, at least right now, some of these long-term factors. So consider, for example, globalization. Increased trade among countries and population flows, capital flows, and so forth have helped keep inflation down around the world. So in recent years, there have been pressures to restrain trade, pressures to restrain immigration. And so it's possible that though that particular factor, the globalization factor, might not work as dramatically going forward in terms of keeping inflation restrained. So if the current elevated inflation rate remains high, are there risks to this? And their answer is most certainly there are. So as we've already mentioned, if inflation expectations become unanchored, this can lead to even further increases in actual inflation. Please forgive my very bad handwriting here. Moreover, relatively high inflation does the most damage to people with relatively low incomes. They have the least room to maneuver in terms of dealing with higher costs of necessary goods and services. And remember, we noted just a few minutes ago that those with lower income were seeing the highest wage growth. But these are nominal wage gains. And if you have relatively high inflation, those nominal wage gains are eroded pretty quickly. Moreover, in both the US and around the world, whatever particular political party is in power at the time, inflation doesn't do them any favors. And so there could be political consequences, political blowback in terms of the current elevated rate of inflation, if it stays like this into the elections that will happen, later this year, toward the end of the year in November. But what I want to emphasize here is that it's pretty unlikely that the stagflation, where we saw very high inflation combined with very high unemployment rates, that's extremely unlikely, at least given current information. One reason is that the Federal Reserve is very unlikely to let inflation get much, if any, higher than it currently is. And as we've talked about, the existing supply chain issues are likely to become dramatically improved. And then the final thing we want to talk about here is the Omicron variant of the COVID virus. So this is, only, not even a couple months old now. It's already spread, around the world. It seems to be substantially more transmissible, but generally less serious. So you've got kind of a little trade-off going on here. Well, how much will this impact short-run supply and aggregate demand, relative to the initial COVID outbreak that we had, in 2020? This is unsure here. We don't know yet because it is very early. It could pose, for example, upside inflation risk if supply chains become relatively more constrained. So, for example, countries that are suffering from Omicron, for example, they shut down production. That might reduce supply chain risks, or increase supply chain risk rather, and work to increase inflation. But if there's a corresponding decrease in aggregate demand, people start staying home, buying fewer goods and services, that could put downward pressure on inflation. So again, right now, it remains to be seen. But the aggregate impact is likely to be much less than the initial impact of COVID back in 2020. So in summary, inflation is currently elevated. And again, this is Fed verbiage, and it's going to be expected to remain so for some period of time here, and longer than the Fed expected. There's now more risk of inflation expectations becoming unanchored, which of course, as we mentioned, can work to increase actual inflation. The Fed is likely now on track to dramatically speed up its policy, the removal of policy accommodation. They are tapering their QE more rapidly, and they're more likely to increase the federal funds rate sooner than they anticipated. But the question here is, well, will it be fast enough? In the days gone by, what the Fed did is they preemptively acted if they thought inflation was going to be above 2%, even if it actually hadn't gotten there. Thanks to their policy regime change in 2020, they're going to wait until inflation is actually above 2%, not expected to be above, but actually above. And so what this does is causes the risk of the Fed getting behind the curve. The reason they might get behind the curve is because monetary policy acts on the real economy with, according to Milton Friedman, a long and variable lag. And that's still likely to be true today. For example, financial markets, interest rates, equity prices, exchange rates, and so forth react relatively quickly. But the underlying real economy reacts relatively slowly to changes in monetary policy, months or even a few years. And so given that we've already got a relatively elevated inflation rate, it might take the Fed some time in order to bring that inflation rate under control. And in that intervening time, there are risks. So thank you all very much, everybody.